In today's podcast, Dr. Andrew Wilson and I are going to give you our spring property market preview. Now, spring's traditionally a great time to buy and sell property, but what's ahead for our markets for the last quarter of this year? Well, if you believe the media, we're going to have a terrible time. But if you've been regularly following Dr. Andrew Wilson and me, you'll know that we have a slightly different view. Now, this is the audio of one of our regular weekly Property Insider videos, and you don't need to go to YouTube to watch the video because while we do normally talk about some charts, I think the audio content will be great, but why not go across to YouTube and subscribe to the Michael Yardney's channel, or just go to propertyinsiders.info. I'll leave a link in the show notes, which will take you directly there. But now, let's have a chat with Andrew Wilson, Australia's leading housing economist, so that at the end of today's show, you'll have more clarity about what's ahead for our housing markets.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Well, we're well into spring, which traditionally is a great time to buy and sell properties. But what's ahead for our housing markets for the last quarter of 2022? Looking back on the year so far, our housing markets have had a lot to contend with. Coming off a once-in-a-generation property boom in 2021, our markets had to contend with floods, bushfires, geopolitical problems, a federal election. Hey, remember that? That wasn't that long ago. Inflation, rising interest rates, and falling consumer confidence. Now, last year, almost all property markets around Australia saw strong growth in house prices, but this year, the markets, they're more fragmented, which of course is more normal, with the Sydney and Melbourne property prices in particular slowing down, while other markets are still keeping their momentum. So back to my original question, what's ahead for property for the rest of the year? That's what I want to discuss today with Dr. Andrew Wilson, Chief Economist of My Housing Market, in this week's Property Insider Chat. Hi, Andrew.
Yeah, good day, Michael. And yeah, happy spring, I guess. Spring has sprung. Thankfully, we'll get a bit more warmth. We'll hope. Southern states have been a bit cold this year and a bit cool in our property markets too. But again, we shouldn't expect anything different because winter traditionally is the distracted time of the year. We have two selling seasons, the autumn selling season and the spring selling season. In between, we do the think music thing and that's winter. And maybe if we're fortunate enough, we take a holiday to warmer climes during that period. But there are significant school holidays and a lot of bits and pieces. But the whole concept, it's not a concept. The reality of our selling seasons is that people make their decisions around the calendar year. We see the emergence of more buyers and sellers coming through late August and into September. It's because buyers and sellers are thinking about, well, let's get it all over and done with by Christmas. It's a lengthy process to buy and sell or sell and buy. And that's why the focus then becomes, okay, if we want to do this, let's get it done by the end of the year. Then, of course, we have the autumn selling season, which is people have been on holidays over January, over December, and they start thinking through that period, well, maybe it's time to get that bigger house, Michael. Let's start doing it and let's get it over and done with before the middle of the year. So that's why we have those two seasons. It's really nothing to do with the weather primarily. And of course, that's what's occurring now. We've come through winter. We've come through a tougher winter this year because it's not just seasonal factors that have moderated activity. Of course, we've had affordability raising its ugly head, or maybe not its ugly head, but stabilising our markets after, as you said, very strong period of growth. High house prices have inhibited the capacity of buyers to continue to bid up property. A lot of the pent-up demand that was built through the COVID interruptions has now been satisfied, particularly in the markets which had the most severe lockdowns, which was Sydney and Melbourne. That's been satisfied. That pent-up demand resulted in strong house price growth. So affordability fell predictably in Melbourne and Sydney, and then along came higher interest rates, which was the icing on the cake, of course, for affordability, because it meant you had to be earning more to get the same price or the same loan because your interest rate was higher. And of course, the other factor with higher interest rates is the confidence factor, which is very important in the short term. We get the usual blazing headlines of doom and gloom once interest rates start to rise, not really based on any evidence. But anyway, it's a cheap headline and it gets a lot of clicks. So we've had that as well. It's coincided with our winter market. So it's all sort of compounded together and confounded all to create a quieter winter selling season, perhaps, but really not so quiet when we do look at the details. So we're ready to spring into spring, are we not? Typically, but I guess the question has been, will we have a spring selling season this year, Michael? But interestingly, as you suggested, that we've had a mixed bag in terms of the performance of our capital cities. Really, Melbourne and Sydney led the charge up. They were followed by Adelaide, Brisbane and Canberra, and the other capitals, of course. And Melbourne and Sydney then led the charge down. And they're now being followed by the other capital city markets. But once again, we're seeing that sort of lagging impacts because there are now signs emerging that we will have a spring selling season. To what extent relies on a few factors, of course, where will interest rates go? But I think we are certainly got some evidence that the spring selling season in Melbourne and Sydney in particular is upon us. And the most significant one we can use as a forward indicator, Michael, is certainly auction numbers are on the rise. We will see quite strong auction activity in terms of numbers coming through Sydney and Melbourne over September. We're seeing early evidence of that when we look at our forward indicators. So sellers are certainly happy to be in the market in spring as they are. And that's what we typically see. And the numbers aren't too bad, Michael, which is maybe a bit of a surprise to the doomsayers in terms of sellers being happy to test the market. Now, I guess a lot of what will be said are these desperate sellers, coming into the market, wanting to take advantage of what heat's left in it. I don't think that's the case because usually the desperate seller environment is when we have high unemployment. People are having problems meeting their mortgage. But as we know, we've got a remarkably strong economy now. Everybody's got a job, wages are rising. So I guess forced sales aren't really an economic factor. I'm not sure people, given that markets aren't really showing continued significant stress, that people would be seduced into thinking they have to sell now. And even if they do, well, where are they going to live if they sell? We've got a shakeout in that market. But certainly, Michael, we are seeing a lift in auction listing numbers heading into spring. That is a positive sign from the seller's perspective. It is coming particularly from Melbourne and Sydney, which of course are the spring markets. We know that. Still a little bit of a lag from Brisbane and Canberra, and Adelaide are just holding thereabouts. So I think the first signs are that sellers are happy in Melbourne and Sydney, particularly be engaging the market, which is typically what we see as the early part of the spring market. Now, we've seen buyers probably a little surprisingly active through August, Michael. Clearance rates have held up. In fact, they've risen in Sydney and Melbourne. That's really been a buyer scenario that buyers have been quite happy to engage in that winter market, despite perhaps thinking that maybe prices would be lower going forward. So those clearance rates have hovered in Melbourne and Sydney at or above 60%. We haven't seen the sort of 40% we saw back particularly in 2018 when we had a similar sort of fractious market. And, clearance rates are still strong in Adelaide. They've been consistently strong. But as we mentioned before, Canberra and Brisbane have been the underperformers and have come back to the market over August with lower clearance rates and lower sales numbers.
Well, if you listen to the media, if you read the media, you'd be concerned about the spring selling season because it all seems doom and gloom. And we've mentioned a couple of those factors, but in a moment, I'd like to talk about some of the positive factors. But if we look at the negative factors first, there are a few, and we've mentioned them: affordability, rising interest rates, rising inflation, and decreasing borrowing capacity. But Andrew, what I'm seeing is that the banks are saying decreasing borrowing capacity, and that could drop 10, 15, 20%, considering how high interest rates have moved from virtually zero official rates. Because my borrowing capacity drops doesn't mean that you as a vendor have to drop the value of your price. So I think that's where the logic is wrong. They're saying because of lower borrowing capacity, property values will drop 20%. What it really means in my mind is, as a buyer, if my borrowing capacity is dropped, I may have to move to another suburb, an adjoining suburb, or buy a townhouse or a villa unit or an apartment. As you clearly said, there aren't distressed sellers. And that's one of the positive factors, that the banking system is very resilient and there are very few non-performing loans, Andrew.
Yeah, well, that's right, Michael. And like I said, the big picture is very strong for those in terms of consumer sentiment. And the big picture for consumer sentiment is clearly I've got a job, my wages are rising, my property's still worth 30% more than it was 2 years ago, I've got lots of savings in the bank, and how could things really be better? At the end of the day, yes, my real wages are falling, but I have the capacity to absorb that. And even the Reserve Bank is indicating it doesn't know, and it said that quite clearly, it doesn't know if a fall in real wages will impact the economy. And we have a record fall in real wages at the moment. The point is that it's not impacting consumption. People are still out spending. The offsets are very strong, to the point where it's confounding many of the experts that think that this will result in some sort of an ongoing fall in consumer activity.
Well, if you do a checklist of all the things that are positive and all the things that are negative, you'll find there are more positive fundamentals. But consumers, we're emotional. And so at the moment, greed is taking a back seat and fear is really there at the moment. There's the fear of buying early, fear of being involved. And overall consumer sentiment is the lowest it's been for a long, long time. But it seems like with interest rates coming close to their peak, probably peaking early next year, with inflation peaking later this year, once people eventually realise, hey, it's not that bad, I see consumer sentiment getting back and this pent-up demand driving our markets. It may be late spring, it may be early next year.
Well, that's the other point, Michael. If there is this sort of phobia thing happening, fear of being involved, which likely there is, when the fear is addressed as being fear and fear alone, then people will sort of get on with life. And that's the need to think about their dwelling choices and their needs, their accommodation needs. And as we keep saying, Australia's short of housing, terribly short of housing. We're going to have demand coming through offshore from migrants and students, which is only going to add to that shortfall in housing. Building costs, it's not just tough to get through all the green tape and red tape and blue tape that you have to as a developer or a builder. Now you've got to cope with building costs being 25% higher than where they were a year ago. It means supply will continue to lag demand. As I said, if the underlying fear was based on the circumstances of consumers, they got nothing to worry about, really. This is a very strong economy. And look, we've come through a remarkable boom period, Michael, for various reasons we've discussed. And I think that in a way, maybe we'll see the higher interest rate environment and the doom and gloom that it generates being absorbed to some degree by the winter market, which is a distracted market anyway. And maybe that'll mean it'll be pushed behind us a bit quicker. And that once we do start to see things such as higher auction volumes, reasonable clearance rates, sales numbers ticking over, that consumers will realise, well, maybe I've got to start thinking about that old fear of missing out situation and get back into the market after sort of having postponed anything early days, as a result of unfounded fears. Even though it's early days, Michael, we may see July as being the trough of the market, particularly in Sydney and Melbourne. If we look at asking prices, and that's another forward indicator, the decline in asking prices, which is certainly there in July, down by around 2.5% in Sydney and 2% in Melbourne, the decline, even though prices are still lower, look to be less over August than over July. So the trend is now starting to look like prices are bottoming out, that we're seeing the turn of the market from price declines. And we would expect that in winter anyway, Michael. And obviously, as we've said, exacerbated by those affordability issues. But maybe we've just seen that prices will start to bottom out, or are bottoming out now. And obviously with the regeneration through spring, that will put upward pressure on prices.
Another good forward indicator is finance approvals. And while they're slowing down a little bit, last month there was still over $30 billion worth of finance approvals. Somebody's going to be buying, or a lot of people are going to be buying $30 billion worth of properties in the next little while, Andrew.
That's right, Michael. But I think the big picture is that we're certainly seeing what we would consider to be the normal increase in buyer and seller activity coming into September. And that's what we see every year by and large, particularly in Melbourne and Sydney, which are the big spring market. I think that if there's any lag in other spring markets such as Adelaide and Canberra, it'll be because they've had such strong growth more recently than the Melbourne and Sydney market, which is sort of looks like it's now heading into a recovery phase through spring, which is the seasonal impact anyway.
Well, the permanent property pessimists are still out there telling us how much debt Australians have taken on. But if you look at the Australian Bureau of Statistics figures, there's about $10 trillion worth of total value of residential real estate. And overall, all the debt against that is $2 trillion. Our housing markets are in pretty good shape, considering that half of the homeowners don't even have a mortgage.
That's right.
A lot of homeowners who've got a mortgage are still having fixed rate mortgages. A lot of those who have got variable and fixed rate mortgages are still ahead in their payments. And household wealth, it's actually still pretty good, our balance sheets. I know we're paying more for cabbage and cauliflower and broccoli. I'm not even talking about the lettuce that people can't afford anymore. But overall, household wealth is pretty strong, Andrew.
Yes, Mike. I think we're sort of moving past that terrible furphy of Australia's debt levels and what that was going to mean. That's been a tired old story for, a decade now, and it's had absolutely no sort of outcome that was predicted. There are a number of different variables to debt, how you measure it, and of course the offsets that assets have. There's always that measurement of incomes to house prices. But how could possibly house prices continue to rise when incomes weren't keeping up with house price growth? And that was another so-called predictor of house price crashes. But of course, those that were predicting it in those simplistic terms forgot about falling interest rates and the impact that has on positive affordability. And we don't even hear about that anymore. Again, I think the debt scenario, even the Reserve Bank stopped commenting on debt, knowing that it has no impact on the real economy, particularly in the short term, and certainly no impact, aggregated national debt, on housing markets.
Well, over the weekend, I saw a headline in one of the national TV stations saying every suburb in Sydney is in mortgage stress. Really? Now, what they did was they took what it would cost for the average mortgage in the suburb and said it was more than 30% of the gross income for that suburb. But boy, is that a very wrong generalisation in my mind.
These stories, I would have thought even the media were getting a little tired of how wrong these, whatever the measurement process is, and where are the outcomes? Whatever happened to the debt bomb, Michael? The famous debt bomb. Well, I think the only debt bomb was the one that blew up in the faces of those that have been predicting it, and it's blown up, but it still gets legs, but it's just nonsense.
So, on balance, this year is going to finish off a bit weaker than 2021, but I know that earlier this year you made a couple of predictions that Melbourne and Sydney's markets are going to end up lower than they started, but the other states are going to end up a bit higher. So what are your thoughts? How's our property markets going to finish at the end of the year?
I think the prospects are certainly brightening, Michael, that confidence is returning, particularly to the Melbourne and Sydney markets, that, the undersupply of dwellings, again, is an essential force. But I think the clear generation of increased activity over spring is it's a strong economy we've got, Michael, which is just only going to get stronger, really, I think. And people have got all these positives in terms of their personal balance sheets. They're not going to be putting off the big decision of buying or selling a house. And it only perhaps makes them feel that they're in a position to take advantage of a weaker market and perhaps less competition for buyers out there. So most sellers are buyers and buyers are sellers. So they take advantage of being in that market. And at the end of the day, Michael, interest rates are still well below historical averages. The only catch is wages growth. But, the Reserve Bank's predicting wages growth to pick up quite strongly going forward. So I suppose there are many that are hoping that prediction comes right. But I think even notwithstanding that, I think that we're certainly seeing the onset of the spring selling season as usual. The question is just what sort of momentum that will deliver through the 3 months until the end of the year.
It'll also be interesting to see what's going to happen to that backlog in processing visa applications, because there's a desperate cry for immigration, and that people are starting to come in, skilled migrants, backpackers, students to a degree. Interestingly, when you look at the latest migration figures, there's also been a lot of Australians finally leaving the country now that they are able to do that. But all these new people coming in from overseas are not bringing a house with them. So that's going to put extra pressure on the very strong rental markets. So I can see rents only increasing over the next year.
Yeah, that's right, Michael. So as I said, it just validates the fact that we have a shortage of housing, and those that are fortunate enough to be established in the housing market are in a position where they can continue to search for whatever they feel is their next journey in property. And the other point to higher rents is a strong economy is people with their wealth generation are continuing to be drawn to residential investment, validated by high rent returns. Where do you put your money? Well, millions of Australians are small-scale residential investors, and we've seen a surge in investors over the last year. As I said, I think that investors are still part of the spring equation, particularly given prices are lower and yields are higher.
Well, it'll be interesting because the governments are giving many investors a hard time. They've pulled the rug out from the foreign investors, and the Queensland government is going to increase land tax for anyone who owns properties, not just in Queensland, but other states. And most of the states are changing their residential tenancy laws, making them more in favour of the tenant. So again, we see headlines of people getting out of property investment because it's just all getting too hard. That's only going to tighten the rental markets even more.
Yeah, I'm just thinking how they can, what policies the Queensland government can have to stop Brisbane house rents reaching $600 a week median, which is just about to occur, Michael, which is a lot higher than where they were just 2 years ago.
Beware of unintended consequences. So we've got a spring season coming on. We'll be getting back together each week to talk about it. But I think spring has sprung, the grass is riz. I wonder where the birdies is. That sort of comes to mind from when I was a little kid. I think the birdies will be out there too, and they'll be watching the auctions occurring.
Yeah, well, signs are certainly early signs, but the signs are there quite clearly that the market is going to rise into spring, and it's all a question of what sort of momentum that can generate.
Look forward to catching up with you again next week, Andrew.
Yeah, thanks.
Now, I know Andrew and I spoke a lot about what's going to happen for the spring housing markets, so I'd like to just summarise it for you. Clearly, there are both positive and negative fundamentals driving our housing markets. So let me quickly go through those with you. The negative ones are, of course, the fact that it's harder to buy properties. Affordability is an issue because of rising property values and lowering borrowing capacity. Rising interest rates are another issue, and that's again flowing into decreased borrowing capacity. But that doesn't mean that property values are necessarily going to drop. It means certain buyers are not going to be able to buy where they could or the type of property they could a year ago. They may have to move out to other suburbs, but that doesn't mean sellers are going to drop their price to that specific buyer who can't afford it anymore, because people don't need to sell at the moment. Rising inflation is, of course, another negative fundamental. Having said that, inflation is likely to peak at the end of this year, and when it does, the Reserve Bank's similarly going to stop raising interest rates. Of course, lower immigration and therefore lower population growth is a negative, because population growth, household formation really, has been one of the drivers of our property markets, but this is turning around now, and the new Albanese government, well, I guess they're new, they've been around for a little while, but they're suggesting they're going to unblock the hold-ups and allow more migrants to come into the country, more students, and not just skilled migrants, but we need the less skilled migrants to do many of the jobs as well. But the big negative factor at the moment is consumer confidence. Lack of consumer confidence in some ways can become a self-fulfilling prophecy, but as you heard in my chat with Andrew, it's likely that that's now starting to turn around. We're definitely noticing at Metropole more investors and home buyers approaching us wanting to get into the market. Now, may I say that over the last couple of months, strategic investors, those with a long-term focus, have been keeping us very busy over the last couple of months, building plans to get ready to take advantage of this window of opportunity in the property cycle. But now other investors and home buyers are starting to get a little bit of confidence, as Andrew said. So we went through a couple of negative factors there. The positive factors include the fact that our economy is still very strong. Yes, it's going to weaken a little bit. The Reserve Bank wants to slow us down, but that's not going to cause a recession by the looks of things. Another positive factor, of course, is that we've got very low unemployment. Anyone who wants a job has got a job. And as long as people have got a job, they're going to keep their homes. They're going to keep paying their mortgages. And the banks don't want to take over their homes. So even if they've got to eat Maggi noodles for a while, if they're having difficulty paying their mortgage in general, low unemployment and the fact that people have got jobs is a real strong positive for the property market. The other factor that we mentioned, of course, was that household wealth is strong. There's been a war chest of savings over the COVID period, which is slowly being spent. Also, a lot of home owners are well ahead in their mortgage. All the banks are telling us that many banks have already come out with the fact that a large percentage of their borrowers are up to 2 years ahead in their mortgage payments. They've kept paying their mortgages even though interest rates have dropped. They've made the same payments. So that means there's going to be little housing stress and very few underperforming loans, which means there's not going to be forced sellers needing to get out of the property markets. And as I mentioned in my chat with Andrew, there's an overall very low loan-to-value ratio for our housing markets, $2 trillion worth of debt against the whole $10 trillion or so of total value of residential property. So rising interest rates is going to affect a small group of people. But if you think about it, there are usually around 500,000 property transactions a year. So over the last couple of years, during the time that property values increased a lot, there may well have been 1 million property transactions over the 11 million residential properties in Australia at the moment. What that means is that it's only a small group of home buyers or investors who may have in the last couple of years overcommitted themselves. But for most of those, the value of their property would have gone up as well. And even if it goes down a little bit now, all those people who bought properties 5 years ago, 10 years ago, 20, 30 years ago, have got a huge amount of equity in their home, very low loan-to-value ratios. And even those who bought property in the last year or two, the banks have been very careful to make sure they could afford to repay their mortgage with higher interest rates. And a big fundamental that's going to underpin our property markets is the significant undersupply of properties, with very few new apartment dwellings or house and land packages in the pipeline. And all the new construction is going to cost a lot more, as Andrew said. At the moment, it's not viable for a lot of new projects to come out of the ground, especially the more expensive towers of apartments, which means the undersupply is going to remain until prices rise again. The price of new properties is going to rise, pulling up the value of established properties as well. And in the meantime, rentals are going to increase. So overall, there are more positive than negative fundamentals leading into the spring property market. Now, I'm not suggesting property values aren't going to fall further in Sydney and Melbourne. They clearly are. And they're going to grow more slowly in other areas. But there isn't one Australian housing market like they talk about that's going to drop 20, 30%. And there isn't one Melbourne or Sydney property market. There are multiple markets, houses, apartments, villa units, townhouses in the CBD, in the inner suburbs, in the middle ring suburbs, in the outer suburbs. And some areas are going to perform more strongly. And in general, they're going to be where people can afford to and are prepared to pay more to live in great neighbourhoods. So I believe now there's a window of opportunity because, as we've said a couple of times, in due course, inflation's going to peak. In due course, interest rates are going to peak. And then when most people realise, hey, that's as bad as it's going to get, this pent-up demand with people who are sitting in the sidelines at the moment is going to mean that it's going to turn. And the market seemed to turn very quickly. Remember October, November 2019, how quickly things turned. So if you're looking at getting into property as a potential home buyer or as an investor, you're probably wondering, well, what should you do? Should you buy? Should you hold? Should you sell? Like it or not, we have moved into this stage of the cycle where not all properties are going to increase in value. We had an amazing couple of years in property over the last couple of years, 2020, 2021. And yes, we are still going to have rising inflation for the rest of this year. Yes, interest rates are going to go up a little bit more. Yes, we're going to have more economic uncertainty. And there's no doubt talk of recession is going to continue on this year. And the media is going to keep bombarding you with mixed messages, with lots of people claiming it's a bad time to buy a home or investment. On the other hand, as I said a moment ago, more experienced, long-term thinking strategic investors see that now's a great opportunity to get set in the property market at a time when there's less competition. As I said, I see it as a window of opportunity for those with a long-term focus, because in due course, this too shall pass. It always does. So when that happens, greed will overtake fear and buyers will be back in the market and move on with their lives. But in the meantime, you need to be more careful at this stage of the cycle. You can't get involved in just buying any property. We're in the market all day and we're seeing less than 4% of properties currently on the market as investment grade. So why not come to my team at Metropole and have a chat about your needs, see what your plans are. Hey, do you have a strategic plan? Turn to us because we've been investing successfully through, I think it's probably 8 property cycles now, and we'll help you with a time-tested system, frameworks that I have fine-tuned over 5 decades, and a proven track record of buying close to $5 billion worth of properties over the years. And we've got our own teams on the ground to help you. But it all starts with putting a plan together and helping you plan to become the person you plan to become. So go to metropole.com.au and look at our range of services: strategic property advice, property investment, development, property management, whether you're wanting to buy a home, or wealth advisory, or business accelerator mastermind. So go to metropole.com.au, check out what we do, and I look forward to being part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'm going to talk about the miracle of personal development. Now, that's a strong word, miracle, but that was the title given to an article by the late Jim Rohn. Now, by now, if you're a regular listener, you'd know that I often quote Jim Rohn in these mindset messages because he was so influential on my personal development. Jim Rohn passed away a number of years ago, but his messages are timeless, and I think this is one of his most important messages. So let's get on with it. Jim Rohn wrote, one day his mentor, Mr. Shove, said, "Jim, if you want to become wealthy and happy, learn this lesson well. Learn to work harder on yourself than you do on your job." And Jim Rohn said, since that time I've been working on my own personal development, and I must admit this has been the most challenging assignment of all because this business of personal development lasts a lifetime. You see, what you become is far more important than what you get. And when I heard that lesson from Jim Rohn, it started me on the trail of personal development. So instead of asking about your work, your job, what am I getting? Instead, you should be asking yourself, what am I becoming? Getting and becoming are like Siamese twins. What you become directly influences what you get. Jim Rohn said, think of it this way. Most of what you've done today, you've attracted by becoming the person you are today. Now, I've also found that your income really exceeds your personal development. You know, sometimes income takes a lucky jump, but unless you learn to handle the responsibilities that come with it, it'll usually shrink back to the amount you can handle. And boy, have I seen that in the very many property investors I've dealt with and the people that I've mentored. In other words, if somebody suddenly hands you $1 million, you better hurry up and become a millionaire. I believe that if you took all the money in the world and divided it equally, you'd soon find that it'd be back in the same pockets, the same proportion as it was before. Jim Rohn explained it, that it's hard to keep that which you've not obtained through personal development. So he suggested the great axiom of life is to have more than you've got to become more than you are. So this is where you should focus most of your attention. Otherwise, you might have to contend with the axiom of not changing, which is, unless you change how you are, you're always going to have what you've got. Well, this was a slightly longer session, but if you enjoyed my chat with Andrew Wilson, please go to propertyinsiders.info, which will take you to our YouTube channel. I'll leave a link in the show notes, and subscribe because every week we have a chat, something along these lines, usually with a lot of detail, giving you our thoughts about the property markets. And if you found some benefit from today's show and you know somebody else who'd benefit, please share this with them. Tell them about the Michael Yardney podcast, or on Apple iTunes, there's 3 little dots at the bottom of the player that you're listening to right now. There's a share button and there's the same on all the other podcast apps as well. Now, you can catch me in between these shows. Just look for Michael Yardney on social media or join my private Facebook group. Just go to Facebook and look for the Property Update Facebook group. Hey, and I've got a way of saying thank you for subscribing to this show. Go to podcastbonus.com.au and I've got a heap of ebooks and reports to gift you as well. Now, I'll leave a link in the show notes to all of those. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?